Welcome back. Now that we understand the basics of the different types of audits, which again are the compliance audits, operational audits, financial statement audits, where you're trying to give an opinion about the assertions in the financial statements, let's talk about something pretty new and exciting, the Clarity Project or the Clarity Standards. Now, the Clarity Standards first hit the exam in July 2013, and basically what happened is this is one of the most significant changes to auditing and the auditing standards and principles in many, many decades. Not even years, but decades. What happened is it came about because they felt that they needed standards that were easier to understand, easier to follow. So these standards relate to what we call a non-issuer. So a non-issuer, let me jot that down, is a non-issuer or a non-public entity. So that's a non-issuer, non-public entity. That is an entity that is not required to provide audited financial statements to the SEC, for example. Because if you're a publicly traded company, then you're governed by the PCAOB, which is the Peekaboo Public Company Accounting Oversight Board, the PCAOB. That would be for a public company, and we call that public or an issuer. That is called PCAOB. So they still relate to the old, what we'll talk about, generally accepted auditing standards, GAAS or Tippecanoe, which we will cover in a few minutes. But with non-issuers, non-public companies, those are governed by the Auditing Standards Board or the AICPA. So what that basically says is you're not required to report audited financial statements. So what they said is there was a lot of confusion. Like we didn't know when you had to do something or when you should do something. So we kind of needed some clarification to make sure that we knew when you needed to do that. So what that means is they went through and they redrafted all of these generally accepted auditing standards. And what they did is they said, let's really come up with these standards and talk about when you are required to do them or when you should do them. So it was difficult in the old standards to kind of differentiate between when something was required to or must or when you basically just should do something. That's why you'll see in your notes the terms unconditional requirement and presumptively mandatory. Now, if you look up here, the two requirements are unconditional. Unconditional requirements means these are standards you have to follow. So with these standards, they'll say you must or you're required to. So you must or you are or is required to. That means in every circumstance when it appears, you have to do it. Versus presumptively, it's presumed to be mandatory, which means you should do this. This is something you need to do as well, but if you depart from that, if you don't follow the standards, then what does it say? It says then you have to clearly document why you didn't do it. So it's presumptively mandatory, which means we presume it's mandatory that you're going to do it, but if you don't do it, you better let us know why it is you did not follow those standards. That's what's going to be really important. So if you look in your notes, it says an unconditional requirement must be complied with in order for the auditor to complete an engagement in accordance with GAAS. We're still using GAAS, whether it's Clarity or whether it's a public company. An auditor is required to comply with an unconditional requirement, which will always include the word must or the phrase is required to. A presumptively mandatory is one that the auditor is expected to comply with in every circumstance. In rare circumstances, however, the auditor may depart but must document how an alternate procedure was sufficient to achieve the objective of the standard. So those are the words again, should or must. Now you'll see in the next paragraph, the Clarity Project made several changes to introducing things. And here's what it came up with. First of all, came up with new terminology and new definitions. So we have new terminology, new definitions. One of them will be the applicable financial reporting framework. So we're going to talk, instead of always saying we did something in accordance with GAAP, generally accepted accounting principles, we're going to say in accordance with the applicable financial reporting framework, which is a little bit more general, a little bit more broad. It covers GAAP. It may cover IFRS. It may cover, so it covers, ASB auditing standard. So it covers all these other areas, maybe some governmental GAS, governmental auditing standards. So that's called applicable financial reporting framework, some new terminology. It also changed the format of every single standard. So every standard up until now has been as a mnemonic or memory aid that I'm going to teach you called Tippecanoe. So that's Tippecanoe. That's going to still exist for PCAOB, because that's how your generally accepted standards are set up. That's how you did it. In the new Clarity Project, what it's going to do is to clarify. And really, it clarifies when you need to do something. So you'll see that it changed the format of every standard. So for every standard, now it's going to have an introduction, an objective, a definition, requirements, which are these things, required to or should, and then the application of it. when and how do you apply it, and other explanatory material. So that's how every standard is going to be set up, which is how we're going to project or go forward throughout the entire course, where we're talking about how to apply these standards. That's one of the things. The new terminology, new requirements. New requirements basically says we're going to have new requirements that says now you don't have to just look at the applicable financial reporting framework, but you need to evaluate whether or not it's the right framework for your entity. Should they be using cash basis, tax basis, governmental regulatory agency basis, or should they be using accrual? You know, what basis should they be doing? And then finally, the audit report, which we're going to talk about in another section, that had the most significant changes. So with audit reports, it completely changed the report. It gave you headings you have to use instead of a 3-paragraph intro scope opinion. That still exists, but for what? For a PCAOB audit. So for PCAOB, you're still going to have the older audit report intro scope opinion. For the non-issue or non-public AICPA ASB report, it's going to have 4 basic sections, more than 4 paragraphs, but 4 sections where it's going to have the introductory, or basically the report of financial statements. Then it's going to have the auditor's responsibility or management's responsibility, then auditor's responsibility, then your opinion. But as part of that too, we're going to kind of clarify when you're going to add this explanatory paragraph. So for PCAOB, explanatory paragraph, we're adding a paragraph. Here we're going to call it emphasis of a matter or an other matter paragraph. And if there's an issue, we'll add a basis for qualification and so on. We're going to cover that in detail in audit reports. I bet you're excited about that. I'm just trying to give you a quick overview to show you some of the distinction and differences between the two. So let's look at our notes. And we'll see here that some of the major changes, again, that exist. Now, first of all, you'll see here about the format. So as I said earlier, here's the format changes, introductions, and so on. So the first one talks about the introduction. And with the introduction of each of the standards, basically it clarifies the purpose and the scope. So it tells us clearly the purpose of the standard and the scope of the standard, which tells us basically when they do or when they don't apply. Because we're trying to figure out, hey, does this standard apply in this situation or not? So it tells us that. Most will apply to all of your engagements, but some could, for example, be special engagements, like a first-time audit, or if you're using outside experts, things like that. So that could help to adjust when we're going to use it. For example, AUC 500. And AU are auditing standards. So as we talk about research questions, AU, now we may say AUC, which is AU. C is clarity, but they're going to drop the C eventually. So as far as on the exam, will they add the C? They may or they may not. So audit evidence. The standard explains what constitutes audit evidence and addresses the auditor's responsibility to design and perform audit procedures to obtain sufficient, appropriate audit evidence to be able to draw reasonable conclusions on which to base an opinion. So when we're doing an audit, remember, whose statements are these? Management's. Very good. Remember, yell that out. Management. Old air out. Fresh oxygen in. Brain cells crank. You stay awake. You stay awake. You learn. You pass the exam. Become a CPA. Find out what true happiness really means. Okay, so with these audited statements, we're trying to obtain audit evidence. So the introduction talks about audit evidence. It explains what constitutes evidence and addresses our responsibility to obtain sufficient, appropriate, corroborative evidence. We need enough good evidence. Enough quantity. Quality is good, the quality. Corroborative evidence. So that's what the first thing, or basically the introduction, talks about. The second area talks about the objective. And the objective really says, what is it that we're trying to accomplish through compliance with the standard? So that's what the objective talks about, is what are we trying to accomplish? What is it? What is the objective? Why are we applying this standard in this case? So with the objective, we might need to see which objective of the standard applies to which section, for example. So let's go back to audit evidence. And we're going to talk about audit evidence in about 1, 2, 3 sections down the way. We're going to obtain sufficient, appropriate, corroborative evidence. For example, when you're going to give an opinion on these statements, you need evidence. You know, how do I know? We talked earlier about inventory and receivables. With inventory, I need to go out there and observe inventory and ask questions. So inquiry, confirmation, observation, recalculation, recomputation, inspection of documents, inspection of assets. That's obtaining corroborative evidence. So with the objective, it says, the objective of the auditor is to design and perform procedures to enable the auditor to obtain sufficient appropriate evidence to draw reasonable conclusions on which to base an opinion. So it enables the auditor to basically interpret the results of the audit procedures that we're performing in light of the objectives that we're trying to accomplish. So that's what the objective says, and you'll see as it's explained there in your notes. Then we talk about the definitions. And the definitions are, what are the definitions that relate to this term? So when we talk about a definition, we're talking about which definitions relate. And with a definition, if only I could spell it, we talk about sufficient, appropriate, audit, evidence. Well, that's easy for me to say, right? I need what? Sufficient, appropriate, audit, evidence. But what does it mean? What is the definition of sufficiency? What is appropriateness? What is audit evidence? That's what this part of the standard defines for you. So sufficiency may deal with quantity, how much do I need? Appropriateness may deal with the quality. Is it relevant? Is it faithful representation? We're going to talk more about that in the FAR exam. Audit evidence, what is audit evidence? Maybe it's the accounting records or other information that you're obtaining. That is where the definition comes in. Now, the purpose of the definitions, though, is so that the users are looking at, or not the users, but the people that are using the standards, look at it and say, does this apply to us? Because you may be out at a client and you're going to be doing this audit. And they go, oh yeah, all these new standards, yeah, it doesn't really apply to us. For example, maybe there's one that deals with financing receivables. And they go, financing receivables, we don't do that, factor, discount, pledging. But then you find out the financing of receivables includes, based on the definition, accounts receivable, notes receivable, loans receivable. So all of a sudden the definition becomes important because you're realizing, hey, I understand the introduction, the purpose and scope. I understand the accomplishment, the purpose, what it is, our objective. But the definition, I didn't realize, based on the new definition, it does relate to our company. Hey, I guess I better be concerned to make sure that we're actually applying it because it does fit. The fourth section talks about the requirements. And the requirements are what is very, very important. This is one of the more significant changes. Because when we talk about the requirements, that says when are we going to have to do this? That falls back into this. Because remember what I just said, the requirements. What are the requirements? Unconditional requirement, must, required to. Presumptively mandatory, it's presumed that you should do this unless you clearly document why you're not going to do it. So you'll see there, each clarified standard then has requirements. In each section that includes an unconditional or presumptively mandatory, as indicated, the auditor is expected to comply with those. The only exceptions, here are the exceptions. An entire section of GAAS does not apply, such as the section on reliance of the work of internal auditors when the client doesn't have internal auditors. So then you go, oh, we should do it, but we don't have to. A specific requirement does not apply because the condition it is intended to provide audit evidence in relation to does not exist, such as requirements to communicate significant deficiencies and material weaknesses when no weaknesses exist. So you're required to communicate a significant deficiency, a material weakness. We'll talk about that in the internal control section. Well, guess what? We don't have to do it. There's no requirement because we didn't find any. Hey, that's good news. Everybody's happy about that. So that's the requirements. As far as your application, so your application and guidance of or other explanatory material, that really talks about, okay, how this section provides guidance. So it basically says, okay, the section provides suggestions as to how the requirements can be complied with. It gives suggestions as to how you might go about complying with the standard. So it says, okay, how should we actually now apply this in this situation? So for example, we're going to go through when we talk about sufficient appropriate evidence or corroborative evidence. How can I obtain this evidence? Maybe in applying it, I'll give you and I love memory aids and mnemonics. They're your new friend. I-Korea. So it might be inquiry, confirmation, observation, recalculation, reperformance, inspection of assets, inspection of documents, analytical procedures, study of data comparison. So these are the different ways that we're going to actually go ahead and apply this standard. So it kind of goes through and gives you suggestions. Maybe it'll say, okay, I need to check for bank confirmations or receivable confirmations, do a positive or a negative or a blank. And what happens if you don't get a response? Then you need to follow up on that confirmation and so on. So that's what we're going to be talking about throughout the course, right? Throughout the rest of the course, we're talking about how to apply it. I mean, that's really what the bulk of it is, keep the big picture in mind. My goal is to obtain sufficient, appropriate audit evidence, enough good evidence so I can give an opinion on these statements. In order to do so, we're following these standards, which again are called the Clarity Standards. So that's how we're basically applying that information. Now, as I said, a couple of the other things is new terminology. And the new terminology says, for example, that we're going to have this applicable financial reporting framework. And with the applicable financial reporting framework, in the olden days, we just always said that we're doing it in accordance with generally accepted accounting principles, or your GAAP. So we would say GAAP. Now what we're saying is the applicable financial reporting framework. And you'll see that in the audit report section. But what is the definition of the applicable? Whatever applies is applicable to that entity. So it could be GAAP, and usually for the exam, that's what it is. Generally accepted accounting principles. What is GAAP? It's the stuff you studied in school year after year after year. What did you say? FIFO, LIFO, weighted average, moving average, dollar value, LIFO, valuation of inventory, receivables at their net realizable value. That's GAAP. Lower of cost or market for inventory. That's GAAP. So we've been studying that since day one. That's GAAP. But it also might be IFRS, International Financial Reporting Standards, which says inventory instead of lower of cost or market, maybe lower of cost or NRV, net realizable value, which we'll learn in the FAR exam. It could be GAS, Governmental Auditing Standards. So now by saying, hey, in my opinion, the statements are presented fairly in conformity with not GAAP, but the applicable financial reporting framework in the U.S. So that's what we're going to be looking at. We'll learn that in the audit report section down the road. The other thing is new requirements. And the new requirements basically says, hey, I feel like new rules. What are the new rules? New requirements, which says, when does this apply? And with the new requirement says that we're going to have to basically go through and figure out when the applicable financial reporting framework actually applies. And with the applicable financial reporting framework, we may have to evaluate the needs of the users. We may have to look at whether or not the new framework meets the needs of the users and whether or not it is appropriate framework under the circumstances. So maybe the client, for example, wants to prepare their statements not on U.S. GAAP, but maybe a tax basis. So then we can't just say, okay, we have to kind of evaluate whether or not the tax basis will satisfy the needs of the users of these statements. In the olden days, we go, okay, sure, whatever basis, and now we'll give an opinion that it's in conformity with that basis. Now they're saying, here's the new terminology, new requirements is you as the auditor have to evaluate whether or not, what are their needs, does it meet the needs, is it appropriate? So that's something new. And then finally, one of the big changes, probably the biggest change with the Clarity Project is this, which is the audit report. Again, we're going to spend 2-3 hours on this. But the audit report basically said we're readjusting the report, and what we're doing is we're changing terminology. So instead of an unqualified clean opinion, we're going to call it an unmodified. So I'll jot those words down. Here, unmodified equals unqualified. Okay? So unqualified, unmodified. Unqualified means it's a clean opinion. Unmodified means it's not modified, it's a clean. Which basically says, hey, in my opinion, the statements referred to above presents fairly in all material respects. The financial position, balance sheet of EXCO as of 12/31/X1, the results of its operations and cash flows in conformity with the applicable financial reporting framework of the United States. Or it could be, again, it could be a tax basis, right, and so on. So that's what we're going to be saying in that report. And that's one of the things that you're going to see with audit reports that are significant. So to, again, summarize, this is called, again, the Clarity Standards. The Clarity Project changed all that, hit the exam starting July 2013. What it basically did is it tried to clarify for a non-public, non-issuer. And eventually, do you think PCAOB is going to adopt this stuff? Probably down the road. But in the short term, right now it applies to non-public, non-issuers. And what it says is still very similar. And as I go through it, and I'll talk about this in the next section, we're going to talk about our generally accepted auditing standards. The standards are still pretty similar. It's just that instead of it being broken down as specific training and independence and due professional care, now they're breaking it down in this format for each one, introducing objective definition requirements, and then how do you apply that standard for this situation. We're still going to go through, we still have to look at internal control, so we still have to plan it, we have to be independent, we have to obtain information and act with skill, we have to look at internal control. So just like that chart we looked at on that first or second page about the flow of the audit, that still applies under either. So don't get confused about that, but what I want you to see is now specifically here we're going to a lot more detail about the actual flow of that, and that's what is called the new and exciting what? Clarity standards.